Eric, we will be speaking about your 17th annual hedge fund survey, where you were researching and presenting what I call consistent performers. So tell me in your words, Eric, what makes for a consistent performing manager?
Hi, Matthias. Thanks for having me and giving me the opportunity to discuss consistent performers in the hedge fund industry. My work is based on my latest hedge fund review, which is my 17th annual survey. Previous editions were prepared for the Financial Times, for Barron's, the Wall Street Journal, and this year's edition was commissioned by SALT. And the work that goes into helping determine consistent performance is pretty basic. There's nothing magical about it. It's getting a hold of a lot of databases, crunching a lot of numbers, tapping into personal resources and other people's connections to hedge fund industry to hope to put together the most compelling universe of funds possible, and then screening them for consistency. And that's generally what I do in order to first generate a list of funds that I think are worth investors' time to begin their search for a particular allocation. The qualities that I think make up the most consistent performers are those who have specific strategies and investment processes that they stick close to. And that's a real key, because inconsistency is not just a product of market volatility, but it's also a product of when you deviate from a process. And I think that's the most important quality that you should look for in a hedge fund manager. It's not just a matter of being in the right place at the right time, because there's going to be all sorts of kinks and unusual behaviors in markets, year in, year out, cycle in and cycle out. That's to be expected. And the good hedge funds, the most consistent hedge fund managers, know how to navigate these difficult challenges in the markets. And to me, when the market is down, it's not that the hedge fund manager has to be up, because I think that's a hard expectation, especially when the market takes a deep dive. I think it's controlling loss, controlling volatility, and being ahead in absolute terms from where the market is. And in that way, that means over the longer period of time, their average annual performance will be more consistent than most other hedge funds. Because in the large scheme of things, I think the vast majority of hedge funds really aren't worth most investors' time. And it's being able to sift through all of the noise in order to find those funds that I think are most compelling. And that's exactly what the purpose of this survey is.
I don't see anymore these type of high quality in-depth surveys on hedge funds being produced by financial media. Why is that?
In terms of other surveys being done in that track hedge funds, there are not many at all, if any. It wasn't that long ago that Bloomberg, Institutional Investor, Barron's, among other publications, would run an annual review. They're just not happening anymore, and that's largely due to two things. One, I think much of the sentiment towards hedge funds are negative. And then it begs the question, why commit resources to an asset class that people aren't thrilled about? And I think it's a very arbitrary decision, because that's just looking at the surface. And as I said before, there's a lot of hedge funds out there that are not worth their time. But there are a number of good hedge funds which are. And the media is just not making the effort anymore to do that kind of research. And the second reason they're not willing to do it is finances. They just don't want to commit the time, energy, resources on a story that takes several months to develop, where right now the MO for most media outlets is getting out a quick story as promptly as possible and in the most timely manner as possible. And this is why they don't want to produce hedge fund surveys anymore. And it's another reason why I opted to work with SALT this year, because I felt it got me much more closely linked to the right kind of viewership than the other media outlets that I had been working for, despite how significant those publications were.
I mentioned that this is already the 17th annual hedge fund study. Tell us, Eric, how did you get started with this, and why are you continuing these studies? And lastly, why do you think they are important?
The survey that I prepared for SALT is unique. All previous hedge fund surveys that I've ever seen are very rudimentary. They might look at assets, they might look at short-term performance, perhaps 1 year, at most what I did for Barron's 3 years. I did do a survey for the Financial Times that went out 5 years, but that was really an outlier. None of the major publishers ever really dug deeply into hedge funds to really help explain the nature of the performance, not just their numbers, not just the size of assets, not just the wealth of managers, but in fact that give you more color, not just of how they made money, but the volatility, the drawdown, the correlation to the S&P 500, all the different bits and pieces that help give you a bit more information to better understand the nature of performance. So my survey includes 20 different metrics that you'll find, and that's unheard of. None of the surveys I've ever been associated with or those that I've seen, which I haven't been, would ever dare do that. And I think this is what makes this survey unique. And I think it also helps affirm what consistent performers look like and what inconsistent performers look like. And the metrics I follow are not just returns. I do it 1, 3, 5 years, as well as since inception. And the history of some of these funds go back 20 years. So being able to see performance not over the short term, not over the medium term, but also since inception really helps drive home the point of how consistent a fund manager is. I also look at volatility, standard deviation over the same periods. And it's very important to correlate returns and volatility. Same thing for drawdowns, because those drawdowns can occur and can be masked by strong performance that follows. But to be able to see if a fund drops 20, 30% on the way to making a 15 or 20% annualized return is really important if you really want to understand the nuance of management. And also, as I mentioned earlier, the correlation to the S&P 500 is also important. It's not that the funds are likely to be closet indexers. There's just too many different strategies for that to happen. But what the correlation data point tells you is how differentiated that return stream is from the market. Because at the end of the day, that's one of the key reasons why people should invest in hedge funds. It's to find a different way to generate returns that hopefully is somewhat and to some significant degree distinct from the marketplace. Now, you can't disconnect altogether from the market because it does show investor sentiment, and that investor sentiment is going to be affecting all investments. But to be able to see that a fund, a manager, can actually generate decent returns that are uncorrelated to market and yet are comparable to market returns, then you have an additional type of investment that I think that can enhance any portfolio.
What do you think, Eric? Do the mainstream media and also the somewhat more sophisticated media get wrong about hedge funds? And also, does this distorted perception somehow also negatively affect investors?
When I got started with hedge fund surveys, it was with Barron's, and it was right before the Great Recession struck. And I think 2007 was the first year I was tracking. And I knew next to nothing about hedge funds. And the first thing that threw me off about hedge funds is the name itself, because that's misleading. A hedge fund actually may hedge or it may not hedge. And there's so many different types of strategies that hedge fund managers pursue. And the media has gotten this so wrong that anybody who's relying on mainstream publications and even somewhat sophisticated publications are going to miss the larger point. And that is, the hedge fund industry isn't some monolithic entity. So when you read that hedge funds are down, that tells the story. It doesn't. You have to distinguish by strategy. And there's at least 15 distinct major strategies out there that are worth pursuing and looking at in order to understand the range of opportunities that hedge funds offer. The key takeaway that any viewer of this program and anyone who looks at my survey is to understand that hedge funds first and foremost are asset managers. And again, going back to media perception, that's where I think the media gets it wrong, because I think a lot of the writers, they end up being young and they probably are influenced by the old perception that hedge fund managers are swashbuckling kind of investors who are willing to take great risk. And that perception does not characterize the bulk of the industry anymore. And that's largely due to the institutionalization of the industry, because after institutions saw how well hedge funds held up during the tech wreck in 2000, how well they actually survived the Great Recession, which is one thing the media got completely wrong, where hedge funds were condemned. The market was down 37%, and the average long equity long short fund was down 12%. And going back to my thesis, I don't think a fund has to be positive when the market is down 37% to prove its worth and to show that it's a consistent performer. And the media has just distorted that reality. But where the media has gotten it right is that a lot of hedge funds just certainly shouldn't be around, and investors probably shouldn't be considering most of them. And that I would agree with. So the bottom line in terms of what this survey tries to do is isolate all the noise, all of the kinds of funds that I think managers shouldn't be in, because at the end of the day, no one needs to be in a hedge fund. You have to find the right fit, the right manager, the right strategy, the right processes, etc., before you decide to make a commitment into a hedge fund.
You've assembled a very extensive study, Eric. Tell us more about the process that you have used to narrow down the vast universe of hedge funds to just 50 consistent performers. And also, are there any categories of funds that you have included or also left out in your study?
As I mentioned early on, the process of getting this survey underway is by assembling a whole variety of different databases and publications and proprietary sources, and assembling that data in order to see funds that have at least a 5-year minimum return. Because to me, if you look at any shorter period, that just leads to uncertainty. I want to see a manager that generates returns or that extend over a number of years that hopefully include significant variances in the market cycle. Because if you're just dealing with a boom market, that's not necessarily going to tell us much. But if the boom market has some drawdowns, has a bit of a bear mixed in, then you can begin to see how well a hedge fund manager can deal with that. I also want to have $300 million as a minimum in a hedge fund before I would consider it. And the reason is you want to have first-tier service providers. And first-tier service providers are not cheap, whether they're prime brokers, accountants, legal administrators. Having the top flight service providers do a number of things. First and foremost, they help ensure, they don't guarantee, but they help ensure that the integrity of the numbers and all of the data and all of the copy that's being put out is hopefully accurate. And you have a much greater chance that that's the case when you're dealing with first-tier service providers. I also intentionally isolate funds that are sector-specific or strictly commodities or specific country funds from this survey. And the reason is I want to focus only on broad strategies like equity long short, credit long short, distressed, global macro. The reason for that is if you're in a specific market, for whether it's commodities, whether it's currencies, or a specific country that might be benefiting from a trend or a specific sector like biotech that might be on the upswing. What a manager does is really going to be dependent upon the headwind or the tailwind that those specific sub-strategies are experiencing. And to me, I want to be able to measure and gauge how well the hedge fund manager is bringing value by the decisions he or she is making. And that's best done is if their strategies are broad to begin with. And that's why I look only at broad strategies. One thing that I will not include in the hedge fund survey is any funds that are exogenously leveraged. That means those that are leveraging the performance of their core fund. And you might see a version of a fund that's 1.5, 2 times, even 3 times levering that core investment portfolio. To me, I want to see what a manager does in his core portfolio without any exogenous leverage. The leverage I'll consider, of course, is anything that's built into the core portfolio, but nothing that's added on gross after the fact, because that's just misleading. It will exaggerate gains and it will exaggerate losses. And the point of this survey is to help find what managers are doing with the kind of investments that they have selected, not how well they can bump up that return through leverage or suffer more drawdown because of that leverage.
I've never heard of a survey that included performance hurdles when writing or researching about hedge funds. Tell us, what hurdles did you use and why?
I also inserted hurdles into the survey, and that was unique. I've never seen a hedge fund survey that actually has done that. And the point of the hurdle was originally instituted in my 2019 survey for the Wall Street Journal, and that tracked performance through 2018, the trailing 5 years. And I set a hurdle of 5% plus 5% for 2018 because the market, as you remember, was down about 5%, and the hedge fund industry was down a bit more than that. So if one could actually generate plus 5% when generally the market was down and when the industry was down, then I think it speaks uniquely about your ability to generate positive gain during a challenging, not an overwhelmingly negative market, but one in which to be able to be on the plus side of the ledger speaks well of the kind of manager you are. And I decided to maintain that 5% hurdle into the 2020 survey, again with the last year being 2019. And that 5% hurdle was very modest considering the market was up more than 31%. And it's not fair, though, to expect other strategies like credit long short, distressed global macro to have performed anywhere near as well as the equity market did and any equity centric investor or manager. So what I did was just demand that a hedge fund produce returns that were several percentage points above the risk-free rate. That didn't seem like a particularly demanding level of accomplishment for that year. And if you're going to be paying hedge fund fees, that's the very least one should expect to generate or to see from an investment. I should add that another element that a hurdle actually accomplishes is in keeping with Warren Buffett's statement, when the tide goes out, you can see who's swimming with shorts. And by having a minimum level of performance when the market goes down is, I think, a simple way of gauging how effectively disconnected a manager is from just following the major components of the S&P 500 and what kind of a distinct return stream they're generating based on their unique investments. Now, what did all these parameters reveal after I crunched all these numbers? And I was, again, very happy to report that looking at the top 50 funds, not only were we seeing a 5-year trailing average that came very close to matching the S&P 500, but they did so with significantly less risk. There was less standard deviation, and there was a much less significant drawdown that these funds collectively had registered compared to the S&P 500. What these 50 funds reflected was a very low correlation to the market. It was only 0.20, and this meant that they generated these very strong returns without connection with the market itself. And that's really the ultimate point of being in a hedge fund, to find a return stream that's uncorrelated to the market and finding you a different way of generating positive absolute return, and certainly with less risk. And that's what makes these consistent performers so compelling.
Is there a sweet spot or a particularly interesting range of AUM that you found when you identified these 50 consistent hedge fund performers?
Another characteristic that my survey revealed, and I've been noticing this year in and year out, is that while you have some very big names who made my list, like Citadel and Renaissance and Element, the vast majority of managers were running under $900 million, and even some were running under $500 million. And this again confirmed to me the merit of looking at smaller managers. And that kind of doesn't surprise, or never did surprise, because you would think that they will have a much easier time moving in and out of a much wider range of investment opportunities than a larger manager would, because a larger manager has to make a more significant investment to move its needle. A smaller manager would have the entire range of investment possibilities from micro to super large cap, and they could look at them whether they're equities or distressed or any other type of asset class in order to move performance. And so investors should pay closer attention to smaller funds because of their unique ability to generate returns across all parts of the market cycle.
Why did you select 5-year annualized returns as your ranking criteria? And tell us also what type of data have you added to that in order to make this survey really relevant for investors?
One of the important qualities of this survey is that it will help investors to distinguish between funds. What I mean specifically is you might see a 5-year annualized return of 12% with a fund whose volatility is very low, where there's a much greater consistency of performance year in and year out. And that will speak of a kind of fund that personally I would prefer versus a fund that might give you several points greater of annualized return, but you might see much higher volatility that could be significantly more, perhaps 12 or 15 standard deviation annually, and you might see greater drawdown. Now, some investors would prefer taking greater risk, which to me, that's what that kind of fund would reflect, and other investors might prefer giving up some return in order to sleep better at night. So my survey doesn't distinguish between those that are slightly rougher rides versus those that are smoother rides. But the key thing about the survey is that it allows investors to actually see the differences about how a fund might get to a 12% annualized return over 5 years and how one does it when they might see a 15% return over 5 years. And that's a very key distinction of what this survey can provide investors.
How did the top consistent hedge fund performers, as you have ranked them by their 5-year performance through 2019, actually perform in 2020?
So what did these 50 funds do in 2020? I was really surprised and pleased with the results. First quarter, I found that on average, the 50 funds significantly outperformed the market. The market was down nearly 20%, and the 50 funds were down about 7.75%. And it also, that average, significantly outperformed the hedge fund industry, which was down about 11.5%. At the end of the first half of 2020, again, we looked at performance, and these 50 funds were the only entities that were actually in the plus category at the end of the first half. And I thought that really was impressive because the market was still negative, the hedge fund was still negative, and yet these 50 funds, I think, were up about 1.22%. Not a significant difference between what the industry was doing and what the market was doing, but it's good confirmation when you're on the right side of the ledger. And that confirmation got a huge boost with what happened in the third quarter. And what I saw was the net annualized return of the 50 funds through September was up 9.22%. And that significantly outpaced the market, which was up approximately 5.5%. And it was also significantly higher than the hedge fund industry average, which was up 1.7%. Now, we still have a lot more pain to suffer through on the streets due to COVID, and I don't think we're going to be out of this mess for at least another year, if not longer. And so to be able to see how well these 50 will do in the coming quarters, I think is still going to be material in order to discern the merits of the selection process and how well these consistent performers have done during a very challenging period. And I'll be reporting subsequent quarter performance as the data comes in.
That's really interesting. Can I ask you to look a bit deeper into that outperformance?
This kind of outperformance that I just reported begs the question, why? Why have these 50 funds, how have they been able to generate superior performance to the market and to the broad hedge fund industry? Now, I mean, the broad answer to that question is that the huge amount of liquidity that's been flooded into the markets through central bank intervention and government intervention certainly has helped almost all investments. It may actually hide inferior managers because rising tide tends to lift all boats, but it certainly has been a shot in the arm to the markets, and it's why the market rebounded so quickly. And a lot of us are still suspicious of this rally. Many allocators I spoke to referred to it as a bear market rally, but I think they're ready to acquiesce to believe that no, this rally is for real. But certainly that was one reason that the 50 funds benefited. Now, digging into the actual funds themselves, I found that anecdotally, because of the size of the funds tended to be on the smaller side, they were able to benefit by more deft movement in and out of the market, particularly during difficult times. And that shielded their exposure to the drawdown, and it also allowed them to move back into the market when they grew increasingly more confident that the worst of the sell-off was over.
Anything else you want to highlight, Eric? How else are those 50 consistent performers different?
I also found that compared to very large funds, these smaller managers do their own research. And what that means is that they're going to dig out investment opportunities that are going to be below most investors' radars. And that allows them to find investments that the mainstream is not reporting on, that the sell side certainly is not reporting on, and that it takes a unique buy-side research analyst to come up with those advantageous positions. And what I found is that many of the smaller managers under $1 billion were able to carve out their own niche research that revealed opportunities that did extremely well. And that might help explain why the 50 outperformed. Another reason that the 50 outperformed had to do with their short positions. It's important to distinguish shorts, those which are hedges and those which are simply and aggressively opportunistic. And I found that many of the shorts that many of the smaller managers were applying to their portfolio were opportunistic, which means that they were seeing problems in these companies, if they were equity or debt, and that they thought that they were primed for a decline in pricing. Now, that was under normal circumstances. So what did that mean when COVID hit and the market swooned? It meant that these shorts even outperformed far better than what the managers expected. So I think these smaller managers got a boost from their opportunistic shorts. Certainly, that kind of investing isn't limited to smaller managers, but I think a smaller manager, again, as I said before, have a much wider choice of investments, and they can dig out unexplored opportunities that large fund managers probably don't do, because they have to stick to fairly large investments in order to move the needles of their performance.
So, Eric, as we have seen, you have researched hedge funds for many years now, focusing on trying to identify the ones with the most consistent, with the most persistent alpha. In your view, in your experience, what's more important, diversification or concentration?
Another characteristic that enhanced the returns of the 50 funds, especially with the smaller managers, was that more often than not, they tended to run concentrated books. And I have been always attracted to managers who were willing to invest in only a limited number of companies, whether it's debt, equity, what have you. Because to me, that shows a very high conviction in each one of its investments. Now, the weighting might be varied from position to position, but if you're going to put all of your money into a dozen or 2 dozen companies, you're going to know those companies very well, and you're not going to hide behind wide diversification, which is one reason why I think a large portfolio, or many managers' portfolio, is diversified so extensively. I think it shows a lack of willingness to make sure they know each one of their investments thoroughly well. And so the managers who are running a concentrated book, I believe, know their investments much better than most other managers do. So what does that mean during a crisis? I think they can assess whether those positions are more prone to an extended or protracted drawdown during a market collapse, and knowing whether they can rebound quickly because their underlying business models are sound. And that's a very big advantage that concentrated investors have. They also know their companies so well that if they think their investments, particular investments, are going to be in trouble, they can move out of them hopefully sooner than when the rest of the market recognizes a problem in those investments. This point of concentration versus diversification, I also think raises another important facet of hedge fund manager assessment that's worth looking into. To me, there's shelter that large managers have, or even medium-sized managers have, or even small managers for that matter, if they have a large number of positions in their book. To me, they feel like they shelter themselves from any significant collapse in the market if their positions are truly diversified. But at the same time, they seem to be focused more on investor retention rather than superior returns, because I think taking more risk, not in terms of exposure to companies which are extreme and are hard to assess, but because you're willing to focus on a few number of companies, I think distinguishes the outperforming steady manager versus those who are willing to give up the search for really unusual and very high quality companies in exchange for the stability that comes with the kind of diversification that most people are used to. And I think there's an advantage to finding managers who are willing to stick their necks out, to say, I know these companies, I'm going to stay with these companies because I believe in them. And their first and foremost concern is not asset retention, but performance. And that distinguishes, I think, some consistent performers from other fund managers who are trying to retain investors and perhaps be more conservative, and in the process give up the opportunity for higher, more consistent returns.
I see that smaller funds, so under say 900 million, dominate your list. Why do you think is that?
We're now going to talk about the percent of smaller managers that made up the top 50 funds that comprised my 2020 survey. 8 of the first top 10 funds were running less than $900 million. Half of the 50 funds were managing less than $750 million. And 15 of those 50 funds were actually running $500 million or less. So to me, that speaks really clearly that the preponderance of managers that qualified for inclusion based on a purely objective approach towards the survey had given an edge to smaller managers. Again, that's not to take anything away from some of the very large, venerable managers like Citadel, Element, Renaissance. They're all fine, very established companies. But it does raise an interesting paradox, and that is larger managers got that way because there was a great deal of faith in what they did. They had succeeded for a long time, and in the process, they attracted a lot of capital. But something also happens at the same time. And I think what you see, especially among the large allocators, is that they are going to seek headline protection, as it's called, by making sure they invest in the most well-known established names. Also, by being in these larger funds, they can allocate more money. So, for instance, if they have $1 billion to allocate and they could spread that out across 5 managers, that might mean that they have to do research on maybe 20, 25 managers in order to narrow it down to 5, if that many managers are needed to start with. That kind of exposure limits you to only large managers. And it also fuels the asset base of these larger managers because it's a self-fulfilling, very pleasant cycle for these larger managers, in the fact that they keep on attracting allocation. And that's despite whether they're having really good years or just mediocre years. That idea of being in a safe haven means a whole lot to many allocators, especially when they have to answer to boards and to other people about why they were in a given fund.
For larger allocators, it is usually not easy or feasible to look at smaller or even mid-sized managers. Why do you think they still should?
Now, I believe that there's certain specific advantages that smaller managers can deliver an allocator. But because they may not be known, because the allocator who decides to go into a smaller manager is taking the risk of being in a manager that perhaps is not well known at all, they don't want to expose themselves to that. It also means that they would have to research at least twice as many funds in order to allocate $1 billion per se. And generally, that's not done. Now, the same thing also extends to consultancies. When a consultant decides to look into a fund, either on the request of a client or just because they think they can put different allocators into them, they're going to focus more on the larger managers because they know that more of their clients can invest in the larger manager than what would be possible if they were researching a smaller manager. So there's generally a bias throughout the industry that favors the larger managers, and that's irrespective of their performance. And again, that's not to take anything away from how well some of the large managers are doing, but I think the superior, more consistent performance tends to show up in the smaller manager arena. And just take a look at CalPERS, for example. A number of years ago, they decided to pull out of the hedge fund industry. Whether that's true or not, I'm not quite sure, because I still hear, whether it's correct or not, that they do have some exposure. But the problem was they allocated several $1 billion across just a handful of funds. And that clearly suggests that they were only exposed to large managers. And that didn't mean that hedge funds as an asset class was an inferior product to be in for CalPERS. It just meant the funds that they were in were inferior. And I think both the media and CalPERS smudged that reality, and that if they did spend the time, if they allocated across a much greater number of hedge fund managers, they might have seen value in that investment. And I think that's a key takeaway from how any allocator should look at investing into hedge funds.
Anything else you want to point out regarding your research? And secondly, as you're also working with hedge fund databases for your surveys, can you tell us more about survivorship bias and how you deal with that?
When you look at the hedge fund table in the survey, and you see the 20 different columns of information, the first column is how are funds that appeared in the Wall Street Journal. And I included that metric because I thought it was another way of measuring consistent performance. And what I found out is that 35 of the 50 funds that made this year's survey had also made the Wall Street Journal survey I had done the previous year. And I found that very compelling because it reflected managers who not only did well during 2018 and having made the 2019 Wall Street Journal survey, but they were also able to perform very well in 2019 in the fact that they made the 2020 survey. And so that's just one more metric that my survey introduced to the process of looking at the hedge fund industry that may have also contributed to superior performance, especially during this year of COVID. Another factor that's interesting is survivor bias that I think most people are familiar with. I rely initially on what databases are giving me. And one complaint about databases is that they only include funds that still report. So that means that if you have a slew of funds that have struggled, that have closed, they're not going to be captured in the database numbers. What does that mean? That means total averages that are going to be reported will be higher than if the funds that failed and that no longer reported were also included. I can't argue with that. That's a pretty straightforward observation. However, I looked at the positive side of what survivor bias means. And what looking at the data that hedge funds databases provided me allowed me to find managers who have actually been around for a long time. Now, the average lifespan of a hedge fund is 5 years. It turns out that the average lifespan of the 50 funds was almost 12 years. Again, another way to help ensure that the funds that made my list were consistent performers, because they not only delivered sound 5-year trailing numbers, they also showed that they were able to do it across the entire lifespan of the fund. And that's also a very compelling metric in which to gauge whether these hedge funds are worth your time or not.
You mentioned that the average lifespan of your 50 consistent performers is about 12 years, which is, of course, very impressive. But Eric, that also raises the question, what is your view on emerging managers?
I'd like to address one aspect of these long tenured funds. This is not to dismiss the value of an emerging manager. Certainly, there is interest in getting an early place at the table of managers that are starting up funds, especially when they've had established pedigrees at other asset management companies. But still, they are now running the funds on their own. And that means not only are they responsible for performance and investment, they're also responsible for operational efficiencies and running the business of a hedge fund. And that's not an automatic. So I would still rather see 5 years of a manager running both the investment portfolio and the fund's operations before I would feel comfortable allocating money in, because many managers might know how to invest properly, but if the operational side of the business is not first rate, that can suffer. And it also can make it more difficult for investors to get information, to learn about what's happening, and also to make decisions about whether they want to stay in the fund because they are not necessarily getting all the information that they need. So I would like to see a manager have a long track record of at least 5 years of running a shop before I would think it's wise to invest in them.
Thank you very much, Eric. Any other final comments or recommendations?
I'd like to end up this interview with a discussion about what this survey doesn't tell you. And I think this is critical. Anyone who is looking at my survey should consider it just as an introduction to some very interesting managers. It's just the starting point. I would not want anyone to make an investment based exclusively on what I had done with my research and with my reporting. They must do extensive due diligence, and I think most of you know what that will mean. That means going into the shop, even though that might be difficult right now. And if you can't get into the shop because you're concerned of travel, certainly dig deep into all of the documents of the fund, understand their history, making sure that regulatory-wise they've been safe, they've been on the right side of the rules, and that their personnel are first rate going across, there's no issues. And you want to know that the team that's in place has been there for a while, so that you know that operations aren't just the result of who's there right now, but that the group of key people have been doing this and working together for a long time. And I think a very important part of that due diligence is asking the right questions and seeing how managers answer them. I remember during one of my surveys, when I read the risk management section of their presentation, it seemed compelling. And then we saw that they were down 50% during the Great Recession. And so I asked them, well, can you help explain what happened if you had all of these protections in place? And he looked at me kind of coyly and said, well, you might have heard of the Great Recession. And that's where I stopped the interview. This is where something written does not match with the reality of what's happened with the fund. And that was a very simple, gross example that pointed to concern about whether one should invest in a fund. Typically, it's a bit more nuanced than that, but the key thing is to make sure that anything you read about the fund is in sync with what you see in its numbers and in what the managers and the key personnel are telling you. One thing that I really urge people to do, and again, that was not done in this survey, is to ask managers about decisions that didn't work out. Because I've always found when I interview managers, while their successes are fascinating, I'd like to know why, when you're a good manager, why mistakes are made, because inevitably they will be. No one has a batting average of 750 or even 600. And it's a real challenge to avoid making mistakes. And when you do, I'd like to know why. And so I would like to know, why did it happen? How quickly were you able to deal with it? And did you learn from your mistake, and how did it affect the investment process going forward? And if you don't get clear answers from these basic questions, that should give you pause about how the manager learns from his mistakes. It's also important to realize that due diligence doesn't stop the moment you invest. It's critical to continue due diligence because this is not like an open-ended fund or a mutual fund that has daily liquidity and daily reporting. I mean, it takes a month before data about performance is registered with you. It could take even longer. And frankly, hedge fund managers run in a much different way than a traditional mutual fund manager runs, and I think most people know that. But that really begs continuous due diligence in following up with what a manager is doing. Anything is possible, and so even while they may have met the threshold of all of your demands before you selected the fund, you may find out, for example, he plans to open up a new fund. That's going to take away from the time he has in focusing on the fund that you're in. I had interviewed and featured a manager who was very good, had a great long-term track record, and then he decided to get up and move from a Chicago base to Paris because that's where his daughter was in college. And I'm not saying that's the reason why the fund eventually stumbled very badly, but it raised a red flag. And consistent due diligence is essential in order to find if anything is changing in the manner in which the fund is being managed. A fund on occasion may merge with another fund. That happens probably more often during very challenging times, and some funds may in fact be in that space right now, but it's important to get ahead of that. If you hear anything about a fund merging with another fund, you're getting a product that's totally different, and it probably would be best to get out of that fund and wait to see what the merger produces. And then you will see managers who have their own personal issues, whether it's divorce or personal problems. That can only be a distraction from their work. That's not to say you should leave at that point, but you should know what's going on in their lives if you're fortunate enough to hear about those things. There's always going to be unforeseeable events, and that's the key thing to keep an eye on, because that's the only way to get ahead of perhaps something negative happening to the fund. And to wrap this up, I appreciate all the time that you've given me to help explain my research, and I hope it's been helpful to your viewers. First and foremost, no one needs to be in a hedge fund. You need to find the right fit, the right strategy, the right manager. All the bells and whistles need to be in place, and you have to feel comfortable, because if you're not sleeping well at night because you're not certain about what that manager is doing, you shouldn't be in that fund. Managers have consummate control over the fund, and it's critical for you to understand what that control means. As you dig deep into their process, not only before you invest but after, you need to be on top of what's going on. And if you see things that are bothering you, ask questions about them. If you don't get the answers that you think help explain what you're seeing, then consider getting out of the fund, because at the end of the day, as I said earlier, no one needs to be in a hedge fund, and it's only worth being in if you think it's a superior way of finding a revenue stream, a performance stream that's distinct from the market and that can give you the diversity that will help your overall portfolio performance. I appreciate your time, and I hope you can take away some important points from this interview. Bye-bye.